In this video, we're going to take a look at what sectors tend to outperform in a rising rate environment and how we can take advantage of it. We know that interest rates are going up in 2022 even faster than expected because Jay Powell said so in a speech last week. And we can already see this having an effect on the markets as they have been very red in the last couple of weeks. Now, some of this fear can be attributed to the Omicron and Delta fears, but rising interest rates definitely have a different effect on different sectors of the market. First, let's take a look at why interest rates are going up in the first place. In this case, it's because we are now seeing inflation inflecting up well above the Fed's target rate of around 2%. The last CPI reading for November shows inflation coming in at 6.8%. So to try to get back on track, the Fed will be doubling the rate at which they taper their asset purchases until they reach zero, and then start raising interest rates. Currently, this puts us at about March of 2022 to see the first rate hike. Before we get into this video, it's important to know that every rate hike cycle has its own unique characteristics from the ones that happened in the past, and they can't all be compared in the same exact context. Alright, so let's take a look at the sectors that have been hit the hardest since the Fed decided to end the funny money and raise rates sooner than expected. If your portfolio has been hit extremely hard in the last couple of weeks, you're going to want to pay attention to this part of the video because it's likely that your portfolio is overexposed to this sector of the market. In the last couple of weeks, we've seen the most pain in high growth tech companies, specifically software companies, and even more specifically, companies that are not currently profitable. Also, anything that has seen momentum in the October-November rally has basically evaporated before our eyes. Just for a quick example, let's take a look at DocuSign. Now, some people say it was their earnings. I went through their earnings and I didn't think that they were that bad. But when you start getting into these uncertain markets, it just takes the smallest little thing to spur a big sell-off. Robinhood's another one here. They did have some big lockups that expired in December, but still, this thing's just been bleeding for weeks on end. And these are just a few examples. I mean, there is a ton more. Just take a look at Pinterest, Affirm. A lot of these high growth companies are young companies that don't currently turn a profit because they are aggressively reinvesting back into themselves. This makes it much more difficult to value these companies because their valuations have a lot more variables and are based on cash flows that are projected well into the future. They are also likely to be funding their growth with large amounts of debt, which is currently extremely cheap. So when interest rates are expected to be higher in the future, their future cash flows become significantly discounted, which brings down the stock price. The companies that are already losing lots of money are hurt the worst and may go bust in an environment with rising rates and slowing GDP. And during these times where markets fear rising interest rates in the future, historically we tend to see a shift from high growth tech companies to value plays. Let's take a look at February through June of this year when the 10-year Treasury started to rise. During this period, we've seen a substantial sell-off in tech and a shift towards value. Value stocks continued to outperform the market until around July when the 10-year started to inflect down again and tech started coming back a bit. So what other sectors tend to do poorly when there are fears of rates rising? Historically, utilities. And the theory here is that conservative income-focused investors that were in utilities may move over to bonds that should have a higher yield with less the risk. Another underperformer could be real estate depending on how high rates go. With interest rates higher, homes become less affordable as the debt on those assets becomes more expensive. So in essence, you will be able to afford less of a home with the same amount of money because now more of your payment will get chewed up by the interest. It depends on what kind of real estate you're talking about though. I personally like buying rental properties that generate cash flow long term. And because I'm not looking to flip them and resell right away, I'm just not as worried about the short-term price action of real estate as much. Now let's take a look at gold. Gold is a commodity and usually has a correlation with the strength of the dollar. When the dollar is weak, gold goes up, and when the dollar is strong, gold goes down. Interest rates rising is usually a sign of the dollar strengthening, thus we would expect gold to go down. Unless you think we're going to see hyperinflation, then we would expect gold to go up. So now, let's take a look at what sectors tend to outperform as interest rates rise. Value stocks. We already talked about value stocks' inverse relationship with growth stocks, but why do people shift towards these when rates rise? Well, value stocks tend to be larger, mature companies who are established and whose share value tends to appear cheaper than its intrinsic value. They aren't spending huge amounts of money to fund new growth and they aren't expected to have large amounts of debt. Thus, they aren't as susceptible to high interest rates as growth companies are. They also typically have more consistent cash flows and are seen as a safer investment. Financials tend to perform well when rates rise because they're one of the only sectors where net margins actually improve as rates rise. Insurance companies should also do well because their underlying bond assets should be yielding higher returns. Consumer discretionary. Consumer discretionary is thought to perform well when the reason rates are going up is because the economy is strong and growing. But this time around, I just don't personally believe that this sector is going to perform the best going into 2022. And the reason is that this sector already performed so well in 2021 because of low interest rates and stimulus money flushing consumers with extra disposable income. With the fiscal stimulus going away, GDP expected to slow, and inflation currently running rampant, I just don't expect consumers to have more disposable income than they did in 2021. However, if Biden's Build Back Better plan does end up getting passed, this would definitely have an effect on the outcome of this sector. Energy. Energy is another sector that has historically outperformed when rates rise, but is yet another one that I don't think will do so going into next year. Demand for energy has come roaring back with the reigniting of the economy, and supply has not been able to ramp up as fast, causing massive inflation in energy costs. We can expect that when supply finally catches demand, that energy prices will be coming back down to earth. Healthcare. Healthcare tends to perform well in most environments, as no matter what happens to the stock market, people still need it. In 2018, healthcare performed well, finishing the year with a 6.28% return, even as the market was still recovering from the correction caused by the increased rates. Bonds. When rates go up, bond prices should fall, raising the yields on those bonds. I've seen some people saying that with these higher interest rates coming, you may want to invest in short-term bonds or TIPS, but when you add the inflation into the mix, bonds just look very unappealing, whether they're TIPS or not. Unless you're close to retirement or trying to really protect your portfolio, then bonds are probably going to be an underperforming asset. If you have credit card debt, a great investment would be to pay that high interest rate debt off as soon as possible. This applies even in a low rate environment, but especially in a high rate environment. So you may be wondering how to change your portfolio so that you are positioned best for rising rates. Well, that would be very hard for me to answer since each person's portfolio is so different. So let me tell you what I'm going to be doing with mine. I will not be making any changes to the vast majority of my portfolio. It's important to remember to not let these short-term market blips affect your long-term investing strategy. But what if you like trading with a small percentage of your portfolio like I do? Well, I do believe this recent sell-off is a little overblown, and I have recently bought up some tech and growth companies and even went into a little bit of margin. I plan on trading out of a few of these positions on the rebound, enough to pay down some of that margin, and the rest I'm going to hold on for the long term. I'm also keeping my eye on a couple fintechs and insurtechs that have really been beaten down over the last month. Just remember, this is with a small percentage of my portfolio. No one has a crystal ball and can tell you exactly what's going to happen. Not even the best investors in the world. If you're not sure how rising rates are going to affect this market, then the best thing you can do is to diversify. At least then you will be somewhat hedged no matter what happens. Yes, you could potentially not get the highest returns possible, but if you're always trying to time the market with a big percentage of your portfolio, you're eventually going to make a mistake. And it only takes one big mistake to wipe out all of your gains for the year. If you like the information provided in this video and would like to see more, please consider hitting that like button and subscribing so you don't miss any of it. Thanks so much for watching, and I'll see you in the next one.